Not all real estate is created equal, and in 2025, some properties will create cash flow and others will drain your bank account and your sanity. So today, I'm going to be ranking the best and the worst real estate to buy in 2025, based on ROI, cash flow, risk, and scalability. Welcome to the channel that completely flips the script on real estate, mindset, and money. I'm Rob Ragno, and I created Redefine You to do exactly that. Redefine the way you invest in real estate. No fluff, no theory, just raw, real strategy and what is exactly working for us in today's market. This is exactly how I've been investing in real estate to get paid at the closing table and have built-in equity from day one. Now, if you want to learn exactly how to do that, go ahead and click the link below. There's access to a free school community that I've created to give you in one place all the tips, tools, and resources alongside with the exact roadmap that you need to use today to build your real estate portfolio. Now, if you also like and subscribe this video, YouTube will turn me into your personal real estate investment advisor completely for free. Now, without further delay, let's jump into this video where I'm going to rank the best and worst real estate that you could buy in 2025. Now, let's be real. The market environment we're currently in is not something that you could just wing it. You have to know exactly what you're doing in order to be successful to come with a positive outcome. Interest rates are still elevated, insurance rates are still climbing, inventory's tight in all the wrong places, and investors today are still chasing yesterday's strategies. So let me save you the cost of tuition into making bad decisions, and I'll show you exactly what you can lean into in order to be profitable in today's market. Top picks for 2025. Number 1, affordable housing under the $250,000 mark. Why? Low barrier to entry, easier to finance, easier to sell or rent rapidly. There's a massive buyer demand at these affordable prices, and also these homes usually accommodate the average starter renter. Let's go over the equation of one of these affordable purchases. Purchase price, $225,000. Rent, $1,950 a month. PITI, $1,400 a month. Net cash flow, approximately $550 a month, not including the upside of appreciation in the equity and the flexibility on your exit strategy. These are pretty well recession resilient because they still accommodate the blue collar worker who is looking for affordable housing. Pick number 2, small multifamily, 2 to 4 units, where you double the doors and double the income on one loan. This creates better economies of scale, enabling you to have multiple renters in one property, reducing the risk of a vacancy. In the case of a fourplex, if you've got one tenant that moves out, you've got 75% income still generated. If you've got 2 tenants that move out, you still have 50% income coming in to cover the expenses of the property. Let's run over what some of those numbers look like. Purchase price, $400,000 fourplex. Rents, $1,000 per door, totaling $4,000 per month. PITI, $2,200 a month. Net cash flow, roughly $1,450 a month. And guess what? If one tenant bounces, you've still got the other 3 that are paying you covering the spread. Number 3, midterm rentals near hospitals or universities. The Airbnb gold rush has fizzled, but the demand for midterm rentals has skyrocketed. Travel nurses, remote consultants, executives, insurance covered stays are in high demand. This is where tenants will typically stay anywhere between 60 to 120 days in a property, paying upwards to 30 to 60% more than standard rental rates. Let's run the example on some numbers. Renting to a travel nurse would bring in roughly $2,600 a month versus a long-term rent, which is about $1,800 a month in the same market. The great part is you furnish it once and you could turn it over 3 to 4 times a year. This will yield you between $700 to $900 more a month in profits without having to deal with tourists or constant turnover and potential damages to your property. Pick number 4, utilizing the POP method or seller financing. This is where you can actually acquire properties without having to use any cash out of your own pocket or having to qualify for a loan. This is how savvy investors and the Redefine You community has been scaling in today's market without having to yield to today's high interest rates. We're negotiating terms with sellers anywhere between 1 to 3% on 5 to 10 year balloon terms, where we're able to get into a property without having to qualify, utilize any of our own credit, or in many cases, not bring any cash to the table. When structured correctly, utilizing our unique POP method, we're actually leaving with a profit on day one. All right, let's run the numbers to see exactly how this works. Let's say you find a property that is worth $200,000. You're able to negotiate with the seller to $150,000. You have a private lender who's going to give you 80% loan to value on the as-is market value, which means they're going to give you $160,000 based on the $200,000 evaluation. Now, if you're still with me, that math shows that you've bought the property for $150,000, but your private lender has given you $160,000. So 150 minus 160 160 leaves you in the positive $10,000. That's exactly how you get paid on day one. Now that we've covered the best strategies how to get into real estate today, now I want to lay on to you the worst ones that you could stay away from. Coming in at number 1, luxury flips. This does not work in today's environment. Interest rates are still high, cost of materials and labor have not come back down to reality, leaving you with extreme risk exposure and tight margins. This is not a place that you want to be in when you're trying to execute a luxury flip and you've got a $10,000 carrying cost eating into your profits every single month. So let's run the numbers to see what that looks like. You purchase a property for $950K that needs a rehab of $150K. You've got an ARV of approximately $1.2 million. Holding time is between 6 to 9 months at an 8% interest rate. Now, if the market shifts by 5%, guess what? You're underwater. So unless you're ultra capitalized and overly seasoned, this is a complete gamble. Number 2, Class C properties in declining markets that look cheap. These are the types of markets that are alluring because of the cost of entry. But the reality is the rental rates are not enough to support the debt on these properties. So watch out for the properties that are attractive because their purchase price don't actually rent at the level that you need to cover your responsibilities. Aside from not being able to cover your responsibilities, in these types of markets, the tenant profiles are typically problematic. This is going to cost you additional money in management and evictions. One eviction can completely destroy any cash flow that you've created in a 1-year process. Mistake number 3, buying in an oversaturated Airbnb market. I'm talking about those top 10 that keep popping up in your Instagram feed, labeled as the best Airbnb markets. Guess what? You're too late. Between all the regulatory crackdowns, the softening in travel, and the extreme hike in cost for cleaning, and everybody learning how to arbitrage Airbnbs, it's becoming extremely difficult to acquire property at a good price in these heavily inflated markets where the prices were once driven up by overinflated travel. These markets right now are showing too much supply and not enough demand. You can easily spot these listings by just looking for properties online that have the typical Airbnb feel. Luxury furniture with the live green walls and the neon lights. These I would definitely stay away from. And the 4th wrong pick is anything that has a ridiculously high HOA or inflated insurance rates. These are mainly the coastal areas that are getting absolutely crushed. Markets that are experiencing decay in their building structures due to high winds, weather conditions, and extreme exposure to salt. In these markets, buildings are collapsing, roofs are caving in, and properties are flooding. This is creating an HOA disaster with increase in assessments, chargebacks to unit owners, lawsuits left and right. These markets are definitely a no-no. Utilizing these 4 tips, this should be an eye-opener from the markets that you should stay away from. Now, going back to the top picks that I shared with you, this is the exact foundation that you need to start building wealth in 2025. Now, if you want to learn exactly how we build wealth in 2025 utilizing our signature POP method and these unique strategies, click the link below, get access to our free school community where we share with you the tools and resources and lock you in to a community with like-minded individuals who are investing in these properties and these types of markets exactly how you should be doing. If you like and subscribe to this video, the algorithm will put me at the top of your list so you can ensure that you're staying current with all the right and wrong market trends. I'll see you on the other side.